Yes, hello. I was looking to speak with a mortgage broker. Did I get the right number?
You did. How can I help?
So I've got a BRRRR project, and I'm looking to get a little bit of money for some renovations. I'm thinking stained glass windows, like 1600 style Transylvanian church. I want an in-home sauna, a Dracula style organ, one of those ones with like the steam that comes out the horns when you play things the right way. I also want to be able to have the right keys that you play on this organ to open a secret trap door that leads into a speakeasy with some special lighting. Also, I'm going to need custom imported Wakandan vibranium for the shower. Probably going to have about 16 to 17 bathrooms, a chinchilla fur mattress, a skate ramp on the roof. I definitely need an in-house McDonald's restaurant, Richie Rich style. I think that will go really well for today's picky buyer. A moat around the property, a koi pond inside the property, a couple internal hidden hallways, a 25-car garage complete with custom skylights, and maybe like French doors coming out of the office. Is that something you guys can help me with?
That's it, huh? What do we think for the budget? 20,000, 25,000?
Before we talk about that, I want to know, what's your rate? All right, folks, we're talking all things renovation on today's episode of Mortgage Monday. If you've ever wanted to renovate a home, or if you have dreams of becoming the next HGTV star, you can't miss today's episode. Christian Bachelder, welcome to Mortgage Mondays. How are you?
I'm doing good, David. How you doing?
I am glad to hear that. I'm doing great, man. We're sharing the gospel of the mortgage industry so everybody knows about loan products that are available to real estate investors and can tighten up their game, because when the market gets tight like this, you got to adjust with it. Today, we're going to be talking about renovation loans, improving properties, one of my favorite things to do, a staple in the BRRRR method.
But before we get into that, the sponsor of today's video is a long-standing BiggerPockets contributor and America's top turnkey company, REI Nation. With 8,000 plus properties managed, 3,200 plus investors served, and $2 billion in rentals under management, REI Nation stands as a leader in stress-free turnkey investments. Operating in 13 different markets, they offer high-value properties with consistent returns and customer-focused property management services, outperforming the competition. Whether you're a seasoned investor or new to passive asset investing, REI Nation is ready to help you achieve your financial goals. Mitigating risk, protecting capital, and delivering exceptional customer service. They've done it all year after year effortlessly. Ready to kickstart your investing journey? Their website will be linked in our description below, so you can connect with one of their experienced portfolio advisors where your success is their commitment. And now, back to Mortgage Mondays.
So let's start off by just talking about what is a renovation loan.
Usually is the loan used for the B and BRRRR, right? This is your buy loan. This is the one to acquire the property. There's a lot of different ways that you can go about it, but ultimately a renovation loan is getting what you need to do to the property financed so that you can acquire property and better the property with less money out of your pocket.
All right. And what types of renovation loans are available to investors?
Yeah, this is really where I think the industry has kind of a miseducation out there on this. There's not a whole lot of content around this. There's multiple types. So the first ones that come to mind are the ones that do require qualification. So for a lot of the listeners, you guys know the difference between a conventional loan and a DSCR loan, right? That's when you don't qualify conventionally, you go to the DSCR world, where that same kind of process exists in renovation financing. There is conforming renovation financing. Those of you who may know some trigger words, a 203K is the FHA version of it. A HomeStyle renovation loan is the Fannie Mae equivalent of it. What those loans basically do is that they take the property that you're buying now. Let's say you're going to buy a $500,000 house. It's below market. There's potential value out there. Let's say you're going to put $50,000 into it. You're investing 10% of the purchase price into repairs. So your total purchase price is $550,000. Typically, that would be more than you can finance because you're only buying it for $500,000, right? The renovation loan takes the ARV value, the after renovation value, on an appraisal and then lends you a percentage of that number. So if that $50,000 in repairs is going to get the house from $500,000 up to $600,000, they will leverage it based on a $600,000 valuation. So you can get financing on a property that technically doesn't exist yet. Pretty cool.
So you've got Fannie Mae options as well as non-QM options for these?
Yeah. So that's Fannie and FHA. Those are fully underwritten. You qualify with debt to income. It's all the strict, rules of conventional financing, but you do get better interest rates, right? So those are good terms. When you get outside in the same way, when you have to go to DSCR loans as you and I do, David, now, right? We don't qualify conventionally anymore. The same thing happens in renovation loans. There is a non-traditional renovation product. We typically refer to them as bridge loans. Some people historically call them hard money loans, but basically same exact process. You get an ARV appraisal, you lend a percentage of that, you're buying a house and financing renovations within that appraised amount. The difference with hard money loans, and bridge loans and this non-conforming product is that there's not all the conforming underwriting. So no debt to income, there's a lower restriction on FICO score. There's less reserve requirements sometimes. There's little different rulings. However, the downside of it is that it has a higher interest rate. Same way that hard money loans work otherwise, you got to pay to play a little bit there.
Okay, so let's talk about loans that investors typically use to renovate or repair housing. You've got these renovation loans we're talking about today. You've got traditional hard money loans. You've got the new hard money loan style, which we call bridge loans. And then you've got HELOCs. Can you kind of run through each of those four and then give me a definition of what they are and what they do?
Yeah, 100%. Basically, everything can finance potential value add to a property, right? Which is great. A lot of people use different strategies. The first one, so just a reno loan, that's your 203K, your HomeStyle. That's the first category that we talked about. Fully underwritten, debt to income. You can leverage the ARV of the property to build, whether it's additions, renovations, an ADU sometimes, right? You can add value to the property. A traditional hard money loan is no underwriting. I shouldn't say no, but no income underwriting. Very high rate. And that's typically going to be a short term as well, a 12, 24-month term where you need to get in and get out. But you can also still finance the renovations. Next, you talked about a HELOC, David. So that's usually using equity of another house to finance the renovations of your subject property, right? The house that you're purchasing. You can do that. That's not an all-in-one product, right? The HELOC has to be used from something you already have equity in, but absolutely a strategy where you can use a HELOC to potentially value add to your new property. And lastly, just a standard hard money loan. Hard money loans don't necessarily have to finance the renovation. So you can always use a hard money loan just to buy the house and then finance the renovations yourself, or like some people do it on credit cards. I don't recommend that, but you get the renovation done however you can. Maybe you got some zero interest rate intro credit cards, right? And then the goal would be to get out of that hard money loan quickly because once again, they're high rates, quick payment terms. You got to get out in 12 months before that balloon payment, right?
All right, let's talk about which of these loans work best in which scenarios that investors could find. So let's start with a renovation loan. What's the ideal scenario where a renovation loan would fit perfectly?
Yeah, I'll be honest with you guys, they're tough. Conforming renovation loans, once again, the 203K and the HomeStyle loan, there's a much stricter process that goes into closing them. So on a purchase, these are tough. You're probably not going to close a renovation loan in 30 days, a conforming renovation loan. You're probably not going to close it, within your time period for escrow. Maybe you negotiate a 60 or 90-day escrow. Those are more rare, especially in the competitive markets. And the downside is that you have to get, it's called a consultant. You have to get a person who walks you through what you're going to be doing with the renovation. Not your developer, not your contractor. This is actually a person that works with the lender. And they approve your plans, they approve your designs. There's like a whole process to it. So a little harder to underwrite, possible, but not always the best thing to use if you need a quick escrow. Traditional ones are for your classic investor, right? So somebody who uses self-employment, uses real estate to write off their income. They're out of that conventional realm, so the conventional options aren't really there. But they still want to BRRRR, they still want to fix and flip, they still want to get into property, get it renovated, and get the value increased. Those are perfect. That's right where that bridge/hard money loan option really thrives, especially people who know how to budget and complete renovations quickly.
All right, so you could get in, get out quickly with these, and the underwriting is not usually as difficult, right? So it's easier for you, but maybe isn't the best loan. So if you're going to get in and get out quickly, the downside doesn't hurt you as much and the upside is more beneficial because it's speed.
That's absolutely right.
Now let's talk about new hard money loans, which we call bridge. The One Brokerage does a lot of these types of loans. So what's the best scenario for these?
These are for people who want to spend less total out of pocket. Well, a lot of times we can go to 90%, what's called loan to cost. I know everybody knows loan to value. That's your loan versus the value of the property. Loan to cost is your total budget. So that's $500,000 purchase and $50K rehab. You have $550,000 as your cost basis. We can lend 90% of that sometimes. So that's a lot less than putting down 20.
So what you're saying is you can wrap the money you're going to spend on the rehab into the money that you're borrowing from the lender.
That's exactly right.
And then what are the rates like on these bridge loans?
They're hard money rates. You're probably looking in the 10 to 12% range. But once again, I like to think of it this way. Interest rate is considered yearly, right? You pay 12% per year to buy that money. If you get your project done in 3 months, you didn't pay 12%. You paid 1% per month. You only paid 3% to borrow that money. Now, obviously, that means have a real strong plan and structure on how to get out within 3 months because you pay money from the moment you draw that loan to the moment you pay it off.
But again, speed is of the essence here, right?
That's what I'm getting at. Absolutely. Speed is the name of the game in hard money lending.
So of the 3 loans we've talked about so far, renovation loans, traditional hard money, and now bridge, are all of the interest rates pretty much comparable between the 3?
Not necessarily. Hard money and bridge, yes. However, with the renovation, the conforming renovation, it's actually closer to just your Fannie Mae, Freddie Mac rate. So you're talking, 6.5% to 8% range. And because those are fully underwritten loans, right? It's a completely different strategy of loan. They are typically priced a little bit higher than just a standard Fannie Mae purchase. So if Fannie Mae purchase at 6.5%, you're probably like 7.25%, but still way better than the 12%.
So this is what I like to refer to as the BRRRR package, where we have our borrowers come in, they use the bridge loan so they can put only 10% down to buy the property, and then they only have to pay for 10% of the rehab as well. So they keep a lot more money in their pocket. They get the rehab done quickly. Then we refinance out of it into a conventional loan, a vacation property loan, a DSCR loan, the bank statement loan, but something that's going to be cheaper and more affordable for the long term. So you get the best of both worlds. So we've covered the upsides of all four loans. What are the downsides of these loans? Just briefly go through it, starting with the renovation loan.
Yeah, really the downside is getting the contractor quote, right? All of these loans across the board require you to very detailed, not like $20,000 for renovations. I'm talking like what the roof costs, what the flooring costs, the windows costs. Like we need a detailed contractor budget, which a lot of times, contractors aren't really known for being the quickest or most detailed oriented people, right? They kind of just say, oh, this project will take $100,000. Well, that doesn't work with lenders, right? You have to have a very, very concrete step-by-step process of what you plan to do to the property. And the reason for that is that when we get that ARV appraisal, the appraiser appraises everything you're going to do.
Okay, downsides to traditional hard money.
Rates in balloon period, right? They're high rates and you got to pay them off quickly.
All right, downside to the bridge products.
Same concept. Bridge is just a hard money where you're financing the renovation as well. High rates, quick balloon periods.
Maybe if your rehab budget goes above what you submitted, you thought it was going to be $50,000, like you said, it ends up being $75,000. You got to come out of pocket for the extra $25,000 that wasn't submitted to the lender that you were going to borrow, right?
That's right, 100%. Also, last thing is for renovation loans, a lot of times lenders will do inspections. So you don't get all the money up front and then you can go party with it, right? They actually have a process that guarantees you due to the property what you're planning to do. So in the event that you go over budget, the lender may, start to look at that line and say, hey, you're running out of money. We need to prove that you're liquid enough to complete this project, or we'll hold the last draw, right? There's some fine tuning there. You want to definitely make sure that you're getting an accurate quote up front and that you're working with the contractor that you can trust.
Okay. And then we've got one last loan option that a lot of investors use to renovate properties, and these are HELOCs. This is, like you said earlier, when you borrow money against the equity of usually a different property, pull it out and use it to renovate the subject property that we're talking about. What's the upside and the downside of a HELOC?
Yeah, upside is accessibility to cash, right? You don't have to go through underwriting. It's already done and you can just draw that money and use it. You don't have a lender determining what you need to finance, right? You're just buying a property as is and then financing it basically yourself. The downside is they're adjustable, so you don't really know what you can depend on in terms of that interest rate. Most HELOCs are adjustable, I should say. Other than that, HELOCs are a great way to do it. You just need to have equity. So if you don't have equity, there's no HELOC option, right? If you have another property, but downside is you just may not have it.
Now, renovation loans are obviously, of these four, going to have the best rate. So we're going to probably want to start with that. However, like you said earlier, they're going to be the most arduous underwriting process. So should somebody start with a renovation loan? And if they want to start there to get the best rate, what should they expect when it comes to qualifying for these loans?
You need a pre-approval. So you need a lender to review your income, review your liabilities, review your credit score, all of that. You should also expect for a longer escrow period, like we discussed. So the way that you can put yourself in a position to succeed is, don't write a 20-day escrow. You won't close a 203K in 20 days, right? Already have a contractor picked out before you write an offer because we need somebody to act quickly, right? And work with a loan officer that's done them in the past. Work with somebody who knows what the product is about and knows how to close them because they are very difficult loans to close.
How long would you give somebody conservatively to close one of these loans? What should they anticipate?
I'd say not put it shorter than 45, 60 days, maybe at the minimum. 30 would really be, you're probably not going to close in 30. It'd be pushed.
And now these are not always purchase loans, right? These are often like you already own the house and you're going to get the loan for the reno.
That's a good note. You can absolutely do these to refinance. Purchase is mainly where I'm talking about these cons. If you have a renovation, you don't have a closing time. Right. So you can just run it.
So let's say you've got a house, it's stable, it's a live-in flip, or it's an investment property that's churning income. You have the luxury of a 45 to a 60-day close to get a renovation loan to go add another unit to this thing, develop a basement, upgrade the cosmetics, whatever you're looking to do. But if you're trying to buy a property with these loans, you might not get it bought because you could fall out of the escrow. Most sellers don't want to wait 45 to 60 days. And if this is a quick project that you're trying to get in, flip that thing and get out of it, that 60 days could be very expensive because all your other other holding costs are still occurring. All right. What are the questions that they should start off asking to figure out what types of products that person might have and what the costs are going to be?
First and foremost, I'm just asking simple how we let off this phone call. What options do you have to finance the renovation of a property? If it's only a hard money lender, they won't have the 203K and HomeStyles. If it's only conventional lender, they won't have the hard money and bridge option. If you want to see the full picture, the bird's eye view, so to speak, of your possibilities, brokers are usually the best place to start. But then ultimately, once you decide to work with one, you ask them what their rates, what their charges are, what their terms are to get a better deal of the structure of the loan and what you understand going into actually acquiring the property.
All right, good stuff. And if you want more information like this, well, guess what? We've got a buttload, and yes, that is a technical term, of information on the BiggerPockets.com website. We've got forums, we've got blogs, we've got books, we've got webinars, we've got agent finders, we've got legend finders. We've got all kinds of resources if you want to dive deeper into this. And if you prefer looking at my pretty face on video, I really can't blame you. Check out another Mortgage Monday video where Christian and I break down the mortgage industry for you, our beloved BP followers. That's all we got for you today. Make sure you leave a comment in the chat and let us know what you liked about today's episode. If there's something that we didn't cover or what questions you have, we will check that out and make future episodes on those questions for you. We'll see you next week on Mortgage Monday.